Do you expect there to be a big inflationary shock coming from the United States this year?
I think that from an economic perspective, you would expect this to be inflationary. There are just too many moving parts, though. For example, yesterday, we had all of those announcements, and at the same time, you had the oil price decline. For oil importing countries, that would be positive that the oil price is declining. There are too many moving parts. Two things that are of concern. One is that the measures taken could lead to a fragmentation in terms of the global economy, and could actually spur other countries to think that they can justify taking protectionist measures. And protectionist measures are negative for global trade, and global trade is the lifeblood of the global economy. That's the first point. The second point is that to the extent that the measures taken are inflationary, it could slow down the disinflation process that the central banks had so steadfastly worked on since the great inflation of 2022. And the risk is then that the accommodation that was increasingly being provided by central banks, or should I rather say, the reduction in the restrictiveness of monetary policy that we had seen over the past year, could then be brought to an abrupt halt, but there is also a risk that it might be reversed.
Yeah.
And that is what my take would be, but there are just too many moving parts.
There's so many things I want to pick up on there. When you say reversed, I mean, is there a possibility that actually central banks may have to start a hiking cycle again, given the shocks?
One can't take that off the table. One can't even say what the timing of that would be. What I can say is that these are shocks. Central banks tend to look through the shocks. But the lesson from 2021 is that if there is one shock, you can look through it. If it's a multiplicity of shocks, you might have to move earlier, failing which inflation starts to rise, and we end up with a situation.
It truly is amazing how the narrative has changed in the central bank community just over the last few months. The market has priced out a lot of the cuts that were priced into the Fed. What sort of knock-on effect do you think that's going to have on your own decision-making? Are you going to be at the mercy of what the Fed end up doing?
No. The Fed is the Federal Reserve of the United States. They take decisions in the interest of the United States economy. The United States economy is the largest economy in the world. For countries like South Africa, which are small open economies, to the extent that there is an impact on the U.S. economy and thus on the global economy, we take cognizance of that. Our own policy settings move from the point where we say, where is the state of the global economy? What does it mean for the South African economy? And then we calibrate policy accordingly, rather than just following what the Fed is doing.
You've got a 4% inflation target forecast, not target, for this year. How would you say the risks are sitting right now? What are the risks?
Again, the risks that we had identified in the previous year had to do with what happens with the energy prices, what is the outlook for food prices, and domestically there were also issues such as electricity prices and so forth. We had now 4 consecutive months where the fuel pump price has actually been rising. So that risk is actually beginning to materialize. But on the other hand, we have seen food prices decline. We had good rains, and we think that we would have a good crop, and that would have a dampening effect on food prices going forward. Again, we have got to continuously assess the balance of risk and calibrate policy accordingly.
Well, I was going to say that, again, interest rate expectations have also shifted within South Africa and the pricing for what you are expected to do over the course of this year. There's only about 1 rate cut priced in. What have you seen in the data that you think has justified for the markets to be more cautious?
Look, markets move all the time, and as for us, central banks, our job is to sift through the data, project what the outlook looks like and calibrate policy accordingly.
Yeah.
We are going into our policy meeting next week, and we will come with a forecast there and take a decision accordingly.
Yeah. Can I ask you about the outlook for growth? I was reading that, in the past 10 years, South African economy has really struggled to grow more than 1%. But more recently, analysts have turned a lot more bullish, constructive about the outlook going into next year because of some of those easing supply constraints that you spoke about, the electricity situation improving. How do you see the growth outlook for South Africa this year?
Closer to 2%. The forecast ranges from like 1.6 to 2%. Somewhere in between there would be a figure. What is important for us in South Africa had been that we had come to grips with the structural challenges. Mm-hmm. We can back now the issue of the electricity supply constraint and says that we have not had load shedding now close to 300 days, and it's a function of getting the electricity power plants to function, getting the right people in place, bringing additional capacity from the independent power producers and so forth. It has been a partnership between government and the private sector. That model is being taken into the logistics sector with respect to the railway network and with respect to the ports. And as these constraints are being alleviated, which is what the central bank has always been arguing for, that if you relieve these constraints, you are able to lift the potential growth rate of the economy. Because if we do not lift the potential growth rate, as it stands now, if this economy was to grow by 1.7, 1.9, even 2% this year, we will close the output gap. So it is very important that we lift the potential growth rate so that we do not see inflationary pressures building up as a result of the economic growth accelerating.